You have all the pieces. You know what an order block is. You know what an FVG is. You know the 3 confirmation candles. But when you sit down in front of a live chart, you don't know which time frame to look at first, which zone to prioritize, or when exactly to pull the trigger. You have knowledge without a sequence. Today, that changes. I'm going to walk you through a complete trade setup, from the daily chart all the way down to the 15-minute entry candle, and you will see exactly how every concept in this course connects into a single workflow. The top-down approach is not a trading strategy. It is a decision filter. Most retail traders look at one time frame and try to trade everything they see on it. Institutional traders use higher time frames to define the context, the direction, the key levels, the major zones, and only drop to lower time frames to time their execution. The HTF tells you where. The LTF tells you when. Both are mandatory. Neither works without the other. Step 1 of the top-down framework. Determine your HTF bias on the daily chart. This is the non-negotiable starting point. Before you look at any other time frame, you need to answer one question. Is the daily chart in a bullish structural phase or a bearish structural phase? You do this by identifying the most recent break of structure and the most recent change of character. If the last BOS was bullish and the most recent swing structure shows higher highs and higher lows, your bias is bullish. You are only looking for long setups until the structure changes. Full stop. Step 2. Identify the premium and discount zones on the daily chart. Draw the most recent swing, from the last significant low to the current high if bullish. Mark the 50% equilibrium level. Everything below equilibrium is the discount zone, where you want to be a buyer. Everything above is premium, where institutions sell. Your trade must originate from the discount zone. If price is currently in premium, you do nothing. You wait. Waiting is not inactivity. Waiting at the right level is the most disciplined trade you can make. Step 3. Drop to the 4-hour chart and locate the SMC confluence zone. You are looking for an area within the daily discount zone where a 4-hour order block, fair value gap, or breaker block exists. This is the zone where institutional orders are resting. You're not looking for one zone. You are looking for 2 or 3 zones that stack at the same price level. That stacking, OB plus FVG at the same level, both inside the daily discount, is what makes a setup institutional grade rather than speculative. Step 4. Check the OTE. Is the confluence zone sitting in the 61.8 to 79% Fibonacci retracement of the 4-hour swing? If yes, you have maximum confluence, daily discount, 4HOB, 4HFVG, and OTE alignment. That is 4 filters. Every additional filter that aligns increases the probability that institutions have orders resting at that level. You are not adding complexity, you are adding evidence. More evidence of the same thesis means a higher quality trade, not a more complicated one. Step 5. Wait for the liquidity sweep. Before price enters your confluence zone, it almost always sweeps a minor liquidity pool, a cluster of stop losses sitting just above a recent swing high, or just below a recent swing low on the 4-hour chart. This sweep is the institutional engineering move. Smart money needs to fill large orders, and they do it by triggering retail stop losses to create the liquidity they need. When you see a wick that sweeps a prior swing and then closes back inside the range, the sweep is complete. That sweep is your signal that price is now heading toward your zone. Step 6. Drop to the 15-minute chart and wait for the confirmation candle. Price has swept the liquidity. It is now entering your 4-hour confluence zone. You switch to the 15-minute chart and you wait. You do not act yet. You watch. You are looking for one of the 3 confirmation patterns from video 9, a pin bar, an engulfing candle, or an inside bar breakout to form within the OB zone on the 15-minute time frame. The candle must close. You do not enter mid-candle. The moment that candle closes and confirms, that is your entry.
Step 7. Entry, stop, and target. Entry is placed at the close of the confirmation candle, or on the retest of the confirmation candle's high for more conservative traders. Stop loss goes below the confirmation candle's low, not below the OB zone, not below the swing low, not below some arbitrary round number, below the candle. Target. Use the next significant liquidity level above, the nearest BSL pool, the most recent swing high, or the opposing premium zone on the 4-hour chart. This gives you a minimum 2-to-1 risk to reward on every setup.
Let's now walk through a complete example from start to finish. No editing, no skipping steps. Daily chart, bullish structure, BOS confirmed, price in discount. 4-hour chart, OB and FVG confluence in the lower 30% of the daily range, OTE band at 61.8. Liquidity, prior swing high swept on the 4-hour. 15-minute chart, price enters the OB, a bullish engulfing candle forms and closes. Entry at the engulfing close, stop below the engulfing candle low. Target, the 4-hour swing high sitting as the next BSL. Result, a 3-to-1 risk-reward setup built entirely from top-down methodology.
The setups you should skip. A high-probability setup only has value if you also know what a low-probability setup looks like, so you don't take it. Skip any setup where the 15-minute confirmation candle forms outside the 4-hour zone. Price must be inside the zone when the candle forms. Skip any setup where the daily bias is neutral or unclear. You need a confirmed structure, not a guess. Skip any setup where there is no prior liquidity sweep. If the sweep hasn't happened yet, the smart money engineering phase isn't complete. And skip any setup where the RR is below 2-to-1. A technically valid setup with a bad RR is still a bad trade. Step 2. Identify the premium and discount zones on the daily chart. Draw the most recent swing, from the last significant low to the current high if bullish. Mark the 50% equilibrium level. Everything below equilibrium is the discount zone, where you want to be a buyer. Everything above is premium, where institutions sell. Your trade must originate from the discount zone. If price is currently in premium, you do nothing. You wait. Waiting is not inactivity. Waiting at the right level is the most disciplined trade you can make. Here is the complete 7-step top-down framework. Step 1. Daily chart. Determine HTF bias. Bullish or bearish structure only. Step 2. Daily chart. Mark premium and discount zones. Only trade in discount for longs. Step 3. 4-hour chart. Locate SMC confluence zone within the daily discount. OB, FVG, or breaker stacking. Step 4. 4-hour chart. Confirm OTE alignment at the 61.8 to 79% band. Step 5. 4-hour chart. Wait for the liquidity sweep of a prior swing. Step 6. 15-minute chart. Wait for a confirmation candle inside the confluence zone. Candle must close. Step 7. Entry at candle close, stop below candle low, target at next BSL. The most important discipline this framework teaches is not a technical skill. It is the skill of inactivity. Most days, you will complete steps 1 through 5 and then wait, and nothing will happen. The 15-minute confirmation candle will not form. The liquidity sweep will not occur. The setup will not materialize. And on those days, the correct action is to close your platform and do something else. The traders who last in this industry are not the ones who trade the most. They are the ones who trade the best. And trading the best means trading only when all 7 steps align.
The free resource for this video is the Top-Down Trade Setup Checklist, a printable one-page PDF containing the full 7-step framework as a pre-session worksheet. Each step has a checkbox and a notes field, so you can work through it in real time before every session. It also includes the confluence scorecard from today's video, daily bias, 4H zone, OTE, sweep, and confirmation candle, so you can score each potential setup before committing to a trade. The link is in the description. Video 11 is where we take everything from phases 1, 2, and 3 and apply it to a full live market review. No hindsight, no cherry picking. That video goes live next. Link at the end of this video.